Hello guys. Hello. Welcome. You're welcome to video 2 of accounting for grads. So we are going to just go straight into it. As you can see on the screen, I've been able to draw out a table that would help everybody in terms of doing the normal accounting recording. You know, one of the most important things that as an entry, as an accounting junior accountant, you'd have to know some basic accounting, which is journal entry, and some other things like trial balance, GL accounts. Very important. But let's just start with this flow. One thing that is just very important that you need to identify, one of the most important flow as an accountant when working is that you are working to prepare 4 main reports, right? 3 out of the 4 are very important in terms of reporting, okay? But the other one is the most important, but you don't need to report it. But to be able to build those 3 reports that you will need to send to your oga pata to say that yes, I've done my work, I've earned my salary. That one is called trial balance. So to do the 3 main reports, you need to first of all prepare your trial balance, and then when you do your trial balance, then you automatically build your 3 main reports. Those 3 main reports are: one, the income statement, aka statement of financial performance; two, the balance sheet, aka statement of financial position; and finally the statement of cash flow. Okay, so the statement of financial performance is is just for you to know, okay, how have we performed in a particular period, maybe last year, this year, last month, last week, any period from one date to another date. Okay. A balance sheet is a position. Okay, where what is the position we are in right now, or what was the position we are in last year, or at the end of last year, or yes, at the end of yesterday. Just telling, okay, how much cash do we have totally in our bank account, how much are we being owed currently, how much are we owing people currently, the position that we are in a particular time. you know um Very important. And the cash flow is just for just to show how cash in the company has flow. To You just want to know whether you have been using your cash properly or you have not been using it properly. That is what the cash flow will show you. Okay, and I'll teach you all these things. But first, let's start with all these accounting terms that you can see here. So now, the first one, as you can see, which is assets, right? One of the most important accounting term that you need to know as an accountant. And assets are basically what the company owns. What you own. If you have a business, the things that you own, that is your own, right, are called assets. So there are 2 types of assets. There's the current assets, and there's the non-current assets. Okay. The next one is expenses. So expenses are things that you pay you need to pay for just to operate. You know, there are two types. There is a cost of sale, and then there is the admin and operations expenses. Then there's also dividend. Okay, dividends are basically money that you pay to your owners, your you know the company that you work for, the CEO, the oga pata pata, not your finance manager. Your finance manager is just a staff, is still a staff, even if it's your oga. But even him, he reports to somebody. He will report to the CEO, and the CEO is probably the owner of the company. He probably has other owners, other people that contributed money to start the business. And they want something at least every year. They call those things that they will be giving them every year, maybe some sort of stipend or something. They're called dividend. You understand? Um, and then we also have liabilities. So liabilities are things that the company owes, not own, owes. If they are owing people, you know. Um, there is current liability and there is non-current liability. Can also call it long-term liabilities. Now there is also revenue. Okay. Uh, you know, there is sales revenue and other income. Okay. Um, we also have equity. Equity basically is just the money contributed by the owners. Okay. So now let me now define each one of them one by one. I gave a brief definition of each one of them. So let's start with current assets. What I wrote here is values belonging to the business that is expected to be sold, used, and disposed of within a year. So current assets. So example of that is maybe cash, the money that you have in the bank account, or the money that you have, the cash that you have physically in your hand, cash in hand, petty cash, or you know cash that is not even in your hand or is not even with you, is with another person, but the person is owing you. And those are receivables, or you know it can also be inventory, stock, if things that you have produced to sell to customers. You also have so many different types of things. Those are little examples. We'll get to it more because of time. So the next one is non-current assets, uh, also known as fixed assets and long-term assets, are valuables belonging to the business that are being used for over a year, things that last long. Okay, so now for example, an example of non-current asset is generator, building, AC, laptop, phones, uh, you know, fixtures, plant and properties, those kind of things, equipments. Um, the reason why they are called non-current assets is because those things will last longer in the company. Um, you don't When you buy an asset, a fixed asset, you don't intend to finish using it within a year. You intend to make it last. Those things they indirectly make you money. Indirectly make you money. If you have an asset that is just there, you're not even using it, it's not making you money, and it's not really an asset, it's just an expense. You just paid money for nothing. You might as well just sell it and get some money from it. Current assets, the reason why is within a year. For example, if you have have a receivable, meaning someone is owing you money, right? you, the company has people owing them money. If they, like for example now, if one of their customer has not paid but they have delivered the goods that the customer has ordered, but the customer has not paid yet, deliver it on credit, yeah, that's a receivable. Okay, you are still expecting the money. So the reason why it's in a year, because you don't expect the customer to not pay the money uh, anytime after 1 year. You are definitely expecting that money within a year. So those things are current. uh, Another example, if you like the inventory one now, stock, if you produce whatever you are selling to customer, or maybe if you buy it from your supplier, you have it in your warehouse, you have not sold them yet, right? But you don't intend to keep them in your warehouse for over a year. If it's food, it can get expired. If it's not even food, it can get spoiled, something can happen. So you intend to sell it within a year. Do you understand? You intend to sell it within a year. Another thing, another current assets example, cash, like I said. The reason why is it, within a year, money that comes in, the money that you collect now, from maybe customer that buys goods from you, the money that you collect from them, you're going to eventually use it to pay off some expenses. You pay off some things, you shall use it within a year. I'm telling you that for real. Within a year you shall use it. Money is very fluid. You Some part of it will leave, some part will stay, but some part will leave. So you can't really say it's a fixed asset. It's impossible. um okay, yeah, let's move on to the next one. Expenses. Cost of sale. Money spent directly to buy materials of goods, to buy materials or products the business sells to customers to make its sales, right? uh, let's just say the money you use to buy the goods, at first is inventory, okay, but then it now becomes cost of sale when you have now sold the product that you bought. For example, let me give an example. I love giving example. If you are selling AC, right? If you have a business of selling AC, you don't produce the AC, you import it from abroad or something, right? Let's say you buy and import 10 ACs from one supplier from abroad, right? Those AC are still with you. They're called stock. Like I said, for current asset, they are currently current assets. You put them in the warehouse. They are current assets, right? The money you used to buy them is classified as current asset for now. But that's before it then becomes a cost asset, a cost of sale. The way it becomes a cost of sale is when you now start selling them. If you sell one of the AC, eh, that amount that you bought that one AC, not the other nine, oh, the money that you used to buy that one AC, when you have sold it, now becomes cost of sale. You will do the record. The journal entry record. It will then change from inventory to cost of sale. It's no more inventory because it's not in your inventory, it's not in your warehouse anymore. It has gone. Okay. So the money that you used to buy it will now be classified not as inventory anymore, but as cost of sale. But the other nine that you have not sold yet, they are still in your warehouse, so they are still classified in your book, your cash book or your financial system as inventory. Okay, don't worry. I'll do. I'm just explaining this. I'll do examples later. Um, Next is expenses, admin, and operations. Money spent indirectly to pay for things the business need to operate. Ehen. So this one now is easy now. You need to, whether you make money or whether you sell or you don't sell, you still need to pay for some things. Like for example, salary. The company that you are working for now, if you start working, whether they sell whether they make money that month whether customer make place order for something and pay or not, whether they did not sell anything at all, what's your own? You are doing your own job. You will need to collect your salary. Abi? Salary is an expense. So it doesn't rely on whether the company sells or not. Cost of sale is an expense that relies on when the company sells something. So that's an example. Another example maybe is for example, if you are working in an office, NEPA takes light and you have generator. The generator doesn't have fuel inside or diesel inside. You need to go and buy diesel. Right? So whether the company makes sale or not, you still need to buy that diesel. Else the staff will not be able to work because you need to charge your laptops to work. You need to switch on the lights of the office in case customer come in. You cannot customer cannot come into the office when it's dark inside. Now it doesn't make sense. So yes, it needs to be the lights needs to be on all day, even if customer does not come in. You predict that customer will come in, but that doesn't mean that they will come in. You are praying that they will come, but if they don't come, it doesn't mean you leave the light switched off all day just because you think customer will not come. So those are expenses. Indirect. Okay, indirect. Next one, dividend. Money paid to shareholders. Like for example, the CEO you're working for, the money, if they, like I think I gave example, I explained this one. If they contribute money to run the business, they will need some small stipend at the end of any period, maybe monthly or at the end of a year or something. But this one comes out of if the company makes profit. The company makes profits and it can be collecting dividend. So yeah, liabilities, non-current liabilities, valuables that does not belong to the business and need to be paid back to the borrower within a year. Okay, current assets. Current liabilities. Just like current assets is within a year. You are owing someone. Instead of someone owing you are owing someone. And you need to pay it back within a year. It can be in the form of payables. In this example, in this case now, if customer pays you, they pay you money, but you have not delivered the goods that they paid for. They pay on credit. You have not delivered the goods that they pay. You owe them. So that money that the customer pays is classified as a payable, as a current liability. Within a year, you obviously intend to give the customer their product that they have ordered for within a year. You don't intend to hold customers goods for over a year. You destroy your reputation. So it's within a year that the company that you work for, any company that will decide to settle their debts when it's current liability. Okay. Um, Non-current liabilities, also known as long-term liabilities, are valuables that does not belong to the business and can be paid back to the borrower anytime after a year. So these are example of this, like bank loan, mortgages, you know, bonds, uh, money that come money. If you want to run a business, you can put your own money. You can contribute your own money, but maybe your own money is not enough. If you have investors, it's not enough. You need more money. You can go to the bank and say, I want to borrow money, give me money. And the bank will say, okay, do you have collateral? Or you bring your collateral. If you give them collateral, they'll say, okay, we'll give you this money, but we want this back as interest. Interest is just like dividend, but dividend is like payment for equity for owners, but and interest is payment for loan, people that loan you money. So the difference between the two is people that you pay dividends, the owners, they are owners of the business. But the bank, when they loan you money, it's just a loan. They just borrow you. They are not owners. Okay. So yeah, you can pay back those loans that you borrowed. You can pay it back definitely in installments, but you obviously will not pay everything back within a year. It can take up to 5 years, 10 years to pay back the money that you have. Little by little, you'll be paying it back monthly or even yearly with interest. You'll be paying it back. Whatever contract or agreement that you have agreed with the bank or the borrower. Next, revenue, sales, money made from sales of the product or services directly branded to the business. For example, if you are working for a company now, the company maybe Hisense. Hisense produces AC or other things that you see branded Hisense on them. Okay. When they sell those, the money that they collect from the customers, those ones are called sales. Okay. But other income, money made from other sales of products or services indirectly branded to the business. Money that are not branded to the business, basically. Things like, for example, maybe a very cheap example now I'll give. Maybe, for example, if one of your dispatch riders goes to deliver goods to one customer in maybe in Ogun State or Ibadan or something, and they are now coming back, instead of wasting the amount of money, instead of because the amount fuel is not cheap, so you decide to make more money on the way back. The dispatch might decide to carry people on the way back from Ogun State or Ibadan. You carry a few people and collect money. So that money, it's classified as income, just extra money made on the side. It's not branded to the company, but it's still money, just extra money coming in. It can also be things like discount received. If like maybe you work for one company that is selling TVs, any different types of TVs, Samsung, Hisense, anything, and the company wants to buy four particular different types of maybe LG TV, and the company calls LG and say, I want to buy 10 TVs from you, right? And the company buys the 10 TVs, and LG now says, okay, because you are buying 10, I'll give you discount, right? So the discount that the company gave, the company collected, is classified as other income. I'll give an example of this later. Don't worry. Um, Equity: funds contributed by shareholders, owner, and founders. So, in the beginning, the CEO, his friends, families, maybe he went to investor company. All of them shall contribute money shall to start the business. Those are equity. The money that they all contributed to start the business is equity. This is not a loan from bank. Like I said, money from bank, loan, borrowers, those ones are, but they are not owners. Okay, it's just the people close to the business are, they are not the ones that are not looking for interest. They don't want interest. They just want dividends. Okay, and difference between dividends and interest, I think I give an example, but more example is that dividend comes from only after the company makes profit. Okay, company has not made profits, you cannot pay out dividend. But interest, whether you make profit or not, or you need to pay back your interest. Okay, yeah, so that's the difference between the two. So borrowers want interest, owners want dividend. Okay, yeah, that should be it for now. um, Video 2 we'll definitely talk about, we'll go into practical examples, and then we'll work as if we're working in an office. Thank you, thank you, thank you. Bye bye.